The Hang Seng, though, is trading with gains of around 0.5%. The Taiwanese index is down 0.5%.
The last 6 months alone, we've raised $30 billion in our markets.
So on the way up, I mean, the closest is the 40-day exponential moving average, which is 25,092.
News that's come in there. Ambuja Cements will be acquiring Orient Cement.
It's absolutely flat. So 24,760 is where the Nifty is opening at.
Some normalization, quote-unquote, in the profitability may be visible.
So yeah, it's ticked up into the green. It's slightly higher.
In the red, but markets are trying to recover from the lows.
More the trust brand in India by implementing some India Connect marketing activities.
We are seeing a second consecutive day of fall, and especially in the mid-cap side of things.
Sharpest strategies, top market trends, unmatched perspectives. The trading day's most comprehensive roundup. Stay ahead with NSE Closing Bell. Broadcasting live from the CNBC-TV18 Motilal Oswal Studios in Mumbai.
Well, that's the day so far, and it is a tough day. And Surubi gave you the signal in the morning with the red color.
Didn't think it was that bad, though.
So, I have to say that the market on the Nifty is, as we speak, just now it's broken below a day before yesterday's low, which is Friday's low, which is 24,567. We are exactly at Friday's low right now. This is, of course, Closing Bell. We're coming to you from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant. With me, my colleagues, Surabhi and Nigel. Guys, hi. Good afternoon.
Hi. I'm just looking out to global markets to see sort of the color over there. But I think while some of the regional markets like Japan, etc., were down, what we're seeing on our screens is actually something very, very different. European markets, for the time being, there is some caution, but like 0.25% down, 0.5% down. What we're seeing specifically in the mid-caps today, second day running, there's a story that's playing out there for sure.
When you have one stock advancing but 10 declining, that's telling you the picture, right? And I'll tell you what, where we are placed right now, we'll be very lucky to get away with this sort of a cut, you know. So if the markets had to bounce all through the day, all those bounces have got sold into. But we need to bounce. We need to bounce from here. Otherwise, it's going to be not such a great close for today's trading session. So let's see how that goes. But no real place to hide today. Mid-cap index down 2%. Portfolio's not feeling too good. But I guess for a longer-term investor, some kind of nibbling, some kind of allocation could gradually take place if you're a longer-term investor. In the near term, though, the picture looks quite muddled. Earnings not picking up, FI selling as well, and no big positive cue is what we're seeing.
And, you know, Nigel, typically what happens is that you want to buy, but you're already in. I mean, you know, most people are already invested. So the margin, unless you created some cash, it becomes very difficult. So, yeah, I mean, if you're sitting on some cash and if you have money to invest, maybe at the margin you start to nibble.
So, you know, the previous time we were at this 24,500. Personally, I put in, you know, SIP. I did a bit of a top-up, very, very marginal. But, you know, that's what I... But this time around, I'm just waiting by for a little bit because not sure where exactly. But otherwise, keep your SIPs going, start nibbling. It's for a longer-term investor, I think so. The easy money has been made.
Absolutely. And, you know, so just a little bit of here and now. You've got absolutely crunching fall in mid-caps and small caps. And, you know, really gut-wrenching because 10:1 declines outnumber advances. And it's been that way for the last many hours now, right? So some 3,000 stocks are down, some 300 stocks are higher. That's the kind of separation between what's down and up. So 2% cut in the mid-cap index, 3% cut in the small-cap index. You know, I wrote this 15 minutes back that Nifty needs to defend 24,567, and it's not being able to, at least right now. We are around that level. Friday's low, 24,570 or so is where we find ourselves at. So we'll see. And of course, for the Nifty Bank, that level is 51,000. Which is, we're not there yet, about 500 points away. The Nifty Bank right now is down about 400 points. So if you want to look at sectors, it's PSU banks, real estate and metals. These are the three areas which are seeing the maximum amount of fall. But it's not really a sectoral kind of play as well. It's not even about results. I mean, yeah, I mean, the results, there are result reactions both on the upside and down. This is City Union Bank and there is something on the downside. It's more broadly, really under pressure kind of a day. So you got that working as an overlay for pretty much everything, good and bad. Surabhi.
I'm just looking at the stock price sort of decimation on the screen that's going on as we speak. Mazgaon Dock has fallen 9%. You have names like 361 Wealth Management. Now here you can argue that sure, I mean earnings were a miss, but down 6% over there. Look at Garden Reach down about 9.5%. Amber is down 11%. Gravita, in Nigel, I think spoke to the management earlier on. You guys had them on Chartbusters, right? I mean the numbers weren't looking that bad or anything. There's 11% decline coming through on Gravita. Jana, again, you can argue that there are asset quality issues on Jana Small Finance Bank, but it's like Prashant said, it's more than earnings today. This is a wider decline at work. And look at the micro cap index, the Nifty micro cap. Look at the Nifty small cap index. They're down about 3.5% each. I don't know, Prashant, I mean, we'll discuss this as we go along. The commentary that came in from Mr. Ashwini Bhatia, the SEBI whole-time member, he was again sounding very cautious on the BSE, SME space, SME IPOs and what's going on over there, talking about F&O and how it can't become a national time pass. But I'm not sure if that has triggered this or whether this has become a bit of a self-fulfilling prophecy, because we've had the large cap selling for the last many weeks now. And maybe it's just, eventually mid-caps also start to cave in. Not quite sure.
I think it's the latter, because I don't think this is that those comments of...
and that's not new, right?
Not new, because look, F&O, the rules are already out. There's nothing new which is on the anvil.
Exactly.
SME, there is something which is coming, which is confirmed. That a discussion paper on... And we are having that discussion at 2:50. We have a guest joining us on that SME issue. And but I don't think that is really causing the fall. It's just a fall. It's not helping the mood. I mean, if you at the margin, it doesn't help.
But it can't be the cause, exactly.
No, absolutely.
On Gravita, just to cite it as an example, the numbers were actually pretty much okay. There was a small miss on the volume growth front. But the problem is the stock in the last 1 year has more than doubled. So that's why, you just want to take some money off the table. And that said, for someone who's believing that, in fact, there is a longer trend in terms of a recycling trend that will take place, a big shift from unorganized to organized. Case in point, this industry, just to cite an example, more than 70% is unorganized right now. So gradually that industry will move to organized, and then there'll be fewer players out there. So that could be a reason. So from the lows of the day, the stock is actually up close to 8%, from the lows of the day. So someone who is selling is because they're sitting on a lot of profit and there's a mild miss out there, and maybe they want to book some profit. While someone who still has a longer term view from here on, they could have bought that dip today. Just citing an example, just another instance, Strides Pharma for very, very long it disappointed. Then the numbers gradually started coming. Take a look at the stock. I don't think there's any big news flow that's come in there, but take a look at the intraday chart of the stock. Slammed. It was in the green just a short while back. Slam, it's down close to around 4%. So I think some money being taken off the table on some of these liquid names.
I think Prashant picked the pulse very aptly in the morning. And he said that when you could be a long-term investor, you could be believing in the India story, etc. But when you're seeing the value of your investments erode 5%, 10%, and you're holding that Mazgaon, you're holding a Garden Reach or a Gravita, and you're seeing, that value dip on a daily basis, at some point in time, you just throw in a towel and say that, I want to preserve the money that I've made. That's the sentiment and the mood that the market is in. So what do you do now? How do you navigate this sort of a market? Mitesh Thakur is our first guest on the show. Mitesh, floor's open. Levels, what are you tracking? Trades, indices, stocks?
Good afternoon, Surbi. So, we've been maintaining a very cautious view on the index, saying that the structure has weakened and there's a higher chance of us eventually breaking below 24,750, 800 zone, which appears to be going through. Now, once this level is gone, which was the first important pivot, and this is also the level from where the, where the rally started post the 6th, 7th of September, and then we made a fresh high. So once this level is gone, I think we will now look at lower levels. So 24,350, 370 was my first minimum target, which I think the markets might do very well. Test it in a day or two, and then 24,200, 24,100 is the zone where a couple of weekly supports kick in. So these are the two levels in the downside. But what is more important is that while you can always look at lower targets, the structure being weak means that this will be a market which will see a lot of supply pressure at higher levels, and therefore the texture, and which is what I said about 10 days back also, that the texture has changed from buy on declines to sell on rallies, exit, and wait out for the entire correction to play out. It could be a time-wise correction if we don't break 24,350, 200 zones. Or it could be a price-based correction if we start breaking below that and head towards the 200-day average on the Nifty, which is at about 350, 400 levels. So that is the way we are placed right now. Not trading the index, but on the stock side, looking at slightly more aggressive positions on the short side and less and conservative positions on the buy side. and mostly trying to play through the option route. Having said that, the calls that I have right now sell on general steel and power. I think that's something which is just about to break the 200-day average at 917, and the weekly pivot of 920 is already taken care of. So we'll suggest selling once it breaks 914, 913, then keep a stop at about 927 and look for a target of 875 to begin with. And the other one which I have on the list is BEL, which I would recommend selling for targets of around 260 and keep a stop at about 277.5.
Okay, all right. Mitesh, thanks very much for the advice. Right now, we'll come back to you in a bit. Let's also address the big story of the day. Hyundai Motors India. What a day to list, right? Well, the shares have been under pressure. It was a tepid listing as expected. And then you have a market like this with sentiment and mood as sour as it is. Let's go across to Sudarshan to get a roundup of brokerages. Lots of new initiations on the stock as well today. Over to you, Sudarshan.
So after being in India for almost 3 decades, Hyundai India has today made its capital market debut. The stock has listed at a minor discount of 1% to the issue price of Rs 1960 per share. But through the day, in line with market moves, stock has remained under pressure. Brokerages, though, remain positive on the stock. We have 4 brokerages initiating coverage on stocks, with 3 of them having a positive stance, while 1 finds the stock expensive at current levels. Take a look what they say. First is Nomura. It has a buy call with a target price of Rs 24.72 per share, implying upside of more than 30% from current levels. Even on the earnings front, it expects a healthy growth. It sees margin rising to 14% by FY27 from 13.1% FY24. And earnings CAGR seen at 17% over FY25-27, aided by 8% volume CAGR, which is likely to be driven by new launches. 2 main reasons for healthy growth that Nomura has pointed out. First, premiumization and company's ability to predict consumer trends. Macquarie too has an outperform call with a target price of ₹22.35 per share. Its target price implies PE of 28 times for FY26 and 25 times for FY27. As per Macquarie, Hyundai deserves to trade at a premium versus peers. And the reasons are, first, it has favorable portfolio mix, and second, premium positioning and market share has stabilized or improved from recent lows. Another brokerage that has a buy call is Motilal Oswal with a target price of Rs 23.45 per share. Motilal expects company to see 17% EPS CAGR over FY25-27, aided by its diverse portfolio mix, which covers 87% of India's passenger vehicle. Also, parent company's inherent strengths can be effectively leveraged by Hyundai India. One brokerage with a negative stance on the stock is MK. It has a reduced call and target is ₹1,750 per share, implying downside of nearly 7% from current levels. And 3 reasons that MK has pointed out are, first, rich valuations, second, muted outlook, and third, higher royalty payment to parent company. On the back of these reasons, MK expects 5% EPS CAGR over FY24-27.
Okay, all right. Sudarshan, thank you very much for the perspective over there. Well, earlier in the day, we did catch up with the top management from Hyundai, both, of course, the global management as well as the India head over here. The global CEO is quite confident of growth and sees more capital investments in India. The company also has many EV launches in the pipeline. Take a look.
We believe with the addition of capacity, which is almost, if you see, 30% capacity addition is happening for HMI in the next 3 years. And this is after a gap of more than 10 years. So I think this is a big moment for the growth of HMI going forward. And we believe that, yes, not only in terms of volume, but the strategy of premiumization, the strategy of adding features, and then, meeting the expectation of the customers will help us to really sustain the volume as well as profitability. We believe that we are in a position to really, grow in line with the market in terms of volume and, of course, always in terms of average selling price to continuously go up.
So if you see, okay, let's see, the market penetration is about 2%, yeah. But we are starting and we are putting the more EVs now. And up to year 2030, we are expecting about 5 EV models running in this market. We are expecting about 10%.
Okay, so that's commentary coming in from Hyundai on their debut the stock market debut, that is. Well, let's get to our next guest on the show. Gurmeet Chadha, Managing Partner and CIO at Complete Circle, is joining in. Gurmeet, where do we even begin? I don't know what stock to talk about. Let's start with the market as a whole. And this mid-cap fall that we've been seeing 2 days in a row, what are you hearing from clients? When typically, this market for the longest time has been buy the every dip market. So it's after a very long time that we're seeing this sort of behavior play out. Even though domestic institutions have been buying, to be fair, they're sitting on cash levels, they're buying every day, offsetting their FPI selling. But what are you hearing, and what's the sense out there right now?
So every correction is unnerving. I think we've seen actually one after a long time, and that's why I think the reaction is what it is. I don't see any panic as such. I think the discussion is still on, how much to put at what levels. And typically, we have seen how large IPOs, have this uncanny ability to lead the correction, right? We've seen that with so many IPOs starting from Reliance Power in 2007, Coal India, Paytms, and now Hyundai. I think Hyundai didn't leave anything on the table, and I remember our discussion saying that there's no rush to subscribe in the IPO. My sense is typically when you see a bit of a sell-off in mid and small cap, that's usually the last leg of the sell-off. But you never know. I think this kind of selling is unusual. I think in October, today's number included, they will cross $10 billion of selling in October alone. Last time you had $8 billion was in COVID in March 2020. So, any market, 10 billion outflow in like, let's say 20 days, or let's say 12, 13 trading days. I think we've done better thanks to, as you rightly said, the buying, cushioning by DIIs. I still think this is a buy on dip market. I think this is where you get more bargains. And a lot of these stocks, look at auto index had doubled. Nigel was discussing recycling themes. Those stocks had doubled. A lot of places we haven't questioned the fact that small mid caps also went up 100% in the last 12, 18 months. So some bit of a pullback is normal, and I think it will bring sanity to the market.
Gurmeet, hi, afternoon. But as you said, there is no... At the margin, are you hearing, especially mid and small caps, is just, some fund selling, anything, any market intel in that sense that you're picking up? What's going on? At the margin, is there a new reason, or is it just profit booking across the board?
Prashant, I would say some bit of rotation. I think because, people have made money, some bit of rotation is of course happening in places where you have made, 2, 3x, some cases 5x, in a lot of small mid-cap counters. So I think some bit of rotation is happening. But when you have such a broad-based selling like this, it typically doesn't help. And I think we've been getting a lot of liquidity last week or so, and we've been trying to deploy it every fall. And we have seen it all. We have seen a 10% correction virtually every year in my last 20 years, except for these last 18 months. And still, it's not 10% from the peak, mind you, right? If you still calculate, I think we stayed about 8%, 9% from the peak. So I think it's normal. Only thing you have to be now careful is that you may not have the same kind of a rebound broad-based. I think because the earnings are soft, and that is where you're deploying is more important rather than just buying the dip. So wherever there is earnings support is, I think, where you should be more anchored to. So where you're deploying in this dip to me makes more relevance than just buying blanket and basket just because the stocks have corrected 20, 30% in some cases, because a lot of the stocks still trade at very high valuation. Nifty small cap after this fall is 33 times, and you're not expecting more than 5-7% EPS growth in that space. So you have to be careful in terms of what you're buying in the.
On a day like today, Gurmeet, people say, right, if you bought Royal Enfield in this year and, instead of that, you bought the stock, then you would make so much returns. Someone who has a Sandro, a Creta, they'll be very happy today. They will be driving home in that, and they didn't get IPO allocation, they'll be even happier. On a day like this, that's the phase of the market. And I think for the Hyundai management, the couple of things that they should not have done is that big dividend payout that they took back 15,000 crores and increasing royalty and coming at these valuations. So maybe that's hindsight, but that's about that. Well, let's move on then. We have Hormuz who's standing by to take us through the fall in mid caps from the highs that we made on September 24th. Hormuz, interesting list coming up. Take it away.
Usually when you see a fall of 5 or 7% from the peak, that is not a cause of concern whatsoever. But for those who are accustomed to seeing mid caps and small caps making new highs every day, wake up, see the indices make a new high and go back to sleep and repeat the action. This would cause some bit of flutter for those kind of market participants for sure. The mid-cap index made a high on the 24th of September around 60,900 odd levels. Since then, 80 stocks of the mid-cap index have delivered negative returns from those levels. Now, this fall is not just a 3 to 5% fall. If you break those 80 stocks down, you would see 11 of them have declined more than 15% from the 24th of September, that is. 24 of them have declined between 10 to 15%, and the number is even more for a 5 to 10% fall, which is 29 stocks. Now, which are those names that have seen the biggest fall since the 24th of September? The usual suspects, right? Vodafone Idea, Cochin Shipyard, Suzlon. The higher they went, the faster they went, the faster they've come down as well. And the list doesn't end there. There are names like L&T Finance, there are names like MRPL, PSUs like HUDCO, GMR Airports also forms a part of this list. All of them down anywhere between 15 to 20%. Now, this is on the index front. Now, if you take a look at specific stocks, that picture looks even more grimmer because Vodafone Idea is down 56% from the peak of 19 rupees that it had made earlier this year. Cochin Shipyard made a record high of near 3,000 in July. In 3 months, the stock has halved. HUDCO, RVNL, a high-flying PSU as well. IPO price of around 20 rupees, a record high of 650, down 32% from those levels. But this is on the index front, it's just a 7% fall. But if you pick up specific stocks and you see that, the picture looks a lot more darker, and that dark is a lot of red.
Oh, absolutely. And those are crunching numbers, really. I'm just thinking of, you know, all the PSU funds and the mid-cap funds that were launched, not even active on the passive side, and what investors might now be feeling or going through. Hormuz, thank you for that. Those numbers really tell a story. The Nifty, just to, complete the picture, the Nifty is down about 6.5% from the peak. The mid-cap index is down 7.5%, a little more than that for the small-cap index. Gurmeet, let's start with the PSU fall, right? Because now on some of these names, like Hormuz pointed out, it's crunching. When you see a stock crash 50% in 3 months, and a lot of investors haven't seen it, right? You and I and most of us here in the studios, we've seen enough cycles, but a lot of new investors haven't. So what would your advice be on navigating the PSU space now?
Subi, to be fair, these ship companies also went up by 6x in a year, right? And that's what I'm saying. We're seeing the fall. We never question outperformance. We always question, corrections and underperformance. Once you start questioning outperformance, that's where you make better allocation and reduce concentration risk. I think there's a lot of value in PSU banks, in my view, if you want to divide it, right? I think a lot of them trade below book value. We've seen with some quarterly updates like Bank of Baroda, I think they've been good updates. There will be a lot of treasury gains with 10-year yields falling 30 basis points. There is some PSU banks which are exhibiting good growth in granular deposits, so that will get reflected in NIM. Credit cost looks pretty contained now. I think there is a structural turnaround in credit underwriting there. So I think there is value there. We find a lot of value in some defense names like HAL, Bharat Electronics. I think there's been a healthy 20-30% correction, but you have order book visibility for next 6-7 years. HAL, for example, it's almost now touching almost 1.5 odd lakh crores in terms of visibility over the next 3-4 years. Similarly, we find some value in selected names in railways. For example, look at Titagarh, almost down 40% from the peak, but you have 900 Vande Bharat, you have metro coaches, you have a backward integration they have done, and so many things offers you value. So you got to be selective here and cherry pick in terms of what has visibility of earnings and growth, and not just buy the blanket. A lot of the not so good PSUs went up because in general PSUs got re-rated. And I think that's the point I made earlier. Be a little selective, focus on earnings. I think there's a lot of value now on the table.
PSUs remind me of one of those parties, and I don't know this, right? When you were at the hottest club in town and you are overstaying the welcome because the deadline's over, but people still want to get in because it is the hottest party in town. But the moment the cops come knocking at the door, the slightest trouble breaks out, everyone's rushing to the exit at the same time, right? And I think maybe that explains this big fall, 30-40% fall that Hormuz just pointed out on some of those PSU names.
Well, but I think Gurmeet is sounding fairly optimistic as well about the future. He's talking about allocating money. He's saying that flows haven't stopped and they are nibbling in as well. Gurmeet, there's a big meeting with regard to what Zomato wants to do on their fundraising plans. And Nimesh had hinted that maybe, in fact, they want to bring that FI holding a little bit lower. The DI holding goes up, more amount of domestic holding, which benefits them ultimately. The stock currently is at the low point of the day. that's a theme that is gaining a lot of traction. Look at the demand for the unlisted Swiggy. Your view on Zomato in this sort of a backdrop at around 250?
Very constructive, Nigel. For example, if you see, they are already talking of 1,000 dark stores by next year. And if you see, for example, I think there's a pressure on the hybrid model. Quick commerce will do well. The traditional retailers, organizers will make a comeback. I think this 24, 48-hour delivery, likes of Big Basket, etc., need to probably reinvent because at tier one, quick commerce is eating them. Imagine DMart saying that a 40-year-old business getting disrupted by a 2-year business, and this is what tech can do. And if you see in US, for example, the online consumption in last 2 decades went up from 5% to 35% now. And you have 8 companies which are $1 trillion. So we don't have an Amazon, we don't have an OTT like Netflix. We don't have our tech companies technically there, right? And I think Zomato has that chance, provided they stay focused on asset allocation. And in this game, because they're raising money, other than the holding, the one guy who actually goes up to 60, 65, then eventually tends to eat everyone. We've seen that with Amazon. So I think even if you see Zepto is raising money, Swiggy's raised money and now probably due for the IPO. So if you see in Blinkit now, even in Blinkit, their market share is now 40%. They are priced about 3, 4, 5% better. And in youngsters, we follow very engagement trends. I think that seems to be emerging as a preferred choice. So maybe to cover your dark spots, you can probably see Swiggy and bit of an allocation to Zepto. There's a lot of action on this market, but we are adding Zomato. So food delivery will grow maybe 4-5% Q and Q. I think it's the e-commerce, quick commerce business which I expect good growth, also contribution margin picked up a bit.
Okay, all right. Gurmeet, we'll leave it there. Good conversation as always and good perspective. Thanks very much for joining us. We'll take a quick commercial break here. We'll come back in a bit from now with more coverage on markets. Also, we'll be joined by Vineet Arora from NAV Capital on the other side. We'll talk markets, but we'll also talk about, SEBI's sort of comments from the whole-time member at SEBI, Mr. Ashwini Bhatia, on F&O and SMEs. The discussion paper on SMEs is due. Vineet is someone who invests in that space, so we'll ask him that. Stay with us.
Welcome back. You with us on Closing Bell. Continues to be quite a difficult afternoon of trade. If you look at the Nifty now, 266 points. It's just getting deeper and deeper. Now there's a huge amount of momentum on the way down. So that level that Prashant was speaking of, the lows that we were discussing, last week's lows, history, completely history, 24,520 on the screen, and we still have half an hour to go. Well, let's look at one particular development that's been in the limelight today as well. And this was a comment made at a Morningstar conference earlier. SEBI whole-time member Ashwini Bhatia raised concerns over the frenzy in the F&O space. He also said that F&O cannot be a national pastime. Not just that, he commented about the progress being made with regards to regulations in the SME IPO space, which has come under increasing scrutiny. It's been under the scanner, so it seems that more regulations could be in the offing. Take a look.
India accounts for the largest volume of F&O globally. We are number one, and globally also, more than 50% of the F&O volume happens in India. This is a crown we do not wish to wear. F&O cannot be and should not be a national pastime, which actually means that savings of retail participants move into the pockets of institutional hands. So just look at the numbers we have told you. 3 years, 1,80,000 crores, and it has been losses for 93% of the investors. 1% make 99%. So your odds are terrible. But the surprising part from SEBI angle is this. The moment we came out with the latest regulation, which kick in sometime in November, investors are protesting that, lot size 5 से 15 क्यों कर दिया? Investors are protesting कि आपने सिर्फ एक ही expiry हफ्ते में क्यों कर दी? Investors are also protesting upfront क्यों कर रहे हो, margining and so on and so forth. But finally, this is becoming systemic. As I said, this F&O cannot be a national pastime. You need to do serious investing. We want India to be prosperous. Wealth is being created very, very fast. And I think investors should participate in the wealth creation that is happening in the country. SME listings are closely monitored by exchanges and SEBI to ensure they don't engage in irrational exuberance, price manipulation, or fraudulent trade practices. We are working on a discussion paper on SME IPOs that should be coming out soon. But what we have seen is pretty disturbing. The way retail participation is happening, the number of times IPO issues are oversubscribed, the way market making happens, the way underwriting happens, and obviously we don't feel very comfortable about what's going on.
Okay, well, those are absolutely clear-cut, sharp words coming in from Mr. Bhatia there at SEBI. We have Vineet Arora, Managing Director at NAV Capital, joining us. Vineet, good afternoon. Good to have you with us here. I believe NAV does invest in SME companies. So to begin with, for us and for our audience, if you can give us a sense of, NAV Capital in terms of SME exposure and what kind of investments you do. And then let's talk about, the comments from SEBI that a discussion paper is around the corner.
Yeah, so we've been very active on the SME space for past 2.5 years. We've done about 60 IPOs as anchor investors, probably by far we're the largest institutional investors in that space in India. And we do believe in that space. We've also done a bit of mainboard. In fact, last month there were 47 IPOs in India, and we participated in 16 of those as anchor investors in the IPOs. And we continue to hold those positions. We talk of froth in the market. What Mr. Bhatia has been telling was talking of a consultation paper. But to me, it's literally like, liquidity and participation go hand in hand. SMEs or small caps or micro caps never had liquidity in the market. As the participation came in, liquidity came in. Now, as it is growing, we are literally stifling it. In my view, what we are doing is literally stifling something which is just mushrooming up. NAV continues to look at small cap, micro cap, because we strongly believe that no large cap was born as large cap. All these companies were a micro cap or a small cap or SME at one point of time.
Yeah.
Became big.
No, obviously you start small and then you grow and become large. But what is in your opinion, are there any things which need to be tightened in the SME space? Since you know this inside out, right? As you said, you're one of the largest institutional participants in the SME space over the last couple of years. Is there any lacuna which needs to be plugged? What would those be specifically? Or do you think it is just SEBI trying to temper the enthusiasm? I mean, because it's probably gone a little too far and it's a regulator trying to do that. What's your sense?
If you look at the data, SMEs, we've had 1,080 IPOs since 2012, which is a 12-year period. And in all, they've raised about 21,538 crores to be precise, as of now. Compare this to Hyundai IPO, which raised 27,000 crores in one IPO. So what kind of froth we're talking of? This is a sector which is very, very important for India to achieve its vision of $30 trillion economy. It provides 40% of India's employment and contributes about the same to the GDP. So number of companies which have hit the markets is not even a fraction of what it can hit. If we can have 5,500 companies on the main board, we can definitely have 6,000-7,000 on SME space. And of the 1,080 companies which have listed, about 320 have actually migrated to the main board. So, in my opinion, the regulator should act as an enabler and not to stifle the growth. Here, we're acting in a bit of haste where we are coming up with, NSE came up with this regulation where they need to have free cash flows for the last 2-3 years. Now, how can a company which is investing and growing have free cash flows? I mean, that is very archaic. That's literally, making sure that the companies which need capital don't get capital, whereas the whole vision was that the companies which actually need capital to grow and who don't have access to capital can come to the SME platform and take capital. That, I think, is getting stifled. Having said that, yes, there are issues in the sector. There have been some very expensive IPOs, where the SEBI should probably increase the disclosure requirements, put more onus on the merchant bankers on the disclosure side, tighten the market making where some bad practices have been going on, which Mr. Bhatia did point out. So those things, yes, I agree we should do. But we should not do something like FCFE, which totally becomes stifling for the sector.
No, and lots of numbers you've given us. 1,080 SME IPOs since 2012, 21,500 crores raised, and 320 have migrated to the main board. Would you have a... Sorry?
319 to be precise.
319, okay. Would you have a sense of out of these 1,080 companies, how many are how many are below the IPO price? How many are above the IPO price? I mean, any broad... How is the segment done? Or
about 900 listed with a positive gain, and my sense would be a similar number would be above the IPO price. Like if I look at our portfolio of the 60 companies that we've invested in, if I look at today, probably about 5 are below the IPO price, and we've exited all of them. But the number is about 10% ballpark, give or take. So 90% is still trading above the IPO price.
Okay, fair enough. You talked about increased disclosures. One thing which I think you would have also heard and has come up is that exchanges approve these DRHPs, right? Approve the companies as they come to the market, unlike the main board where it's the regulator. You got to file with the regulator. Does that sort of how it's done? Does it need a relook, or do you think it can be done with strengthened systems at the exchange level?
I think we should strengthen systems at the exchange level. The whole idea was to make it easier for these smaller companies who don't have the wherewithal to raise capital on the exchange. Once we move to SEBI, SEBI is a regulator. Its job is to enable the legislation and make sure, it's followed. Exchanges are both NSE and BSE have done a fantastic job so far in the segment in terms of promoting the segment, creating a marketplace for them. And I think they are very well equipped to actually handle that. So that should remain with NSE, both NSE and BSE in terms of, approving the IPO process, because they set guidelines which they need to follow.
Okay, all right. A good discussion, Vineet, and I hope we can speak again soon. Thank you for joining us with that perspective. Appreciate it. So that's Vineet Arora of NAV Capital with some thoughts. We'll go into a break right now. We're going to come back. But as we go into a break, I just want to play out these sound bites from the Petroleum and Natural Gas Minister, Hardeep Singh Puri, and what he had to say about all of the talk around city gas distribution companies. And of course, whether they will or will not raise prices to compensate for the cut in APM gas allocation to them. Listen and take that break. We'll see you on the other side.
These things keeps happening up and down here like that. What is the issue?
But there's an expectation that companies may raise prices.
They will? Sir? Which one? Which one? Tell me. Who's here raising prices? Are the OMCs are not raising prices? No. ध्यान से I don't want to. यहाँ के आप तो ब्लॉक कर दिया यार, थोड़ा आगे आ जाओ. हाँ, थोड़ा.
If you can just field the question again.
हाँ जी.
There is an expectation that they may raise prices.
Tell them to talk to us directly, not come through the press.
Welcome back. Well, the markets have gone ahead and broken the 100 EMA as well on the Nifty. You plot the 100 EMA and this selling has come in the last 20 minutes yet again. So any kind of bounce is getting sold into. And as I said at the start of the show, we'll be lucky to get away with a close, at around 2:30 p.m. Heading to 3:30 p.m., well, it's got a little bit worse. And now we have breached that 100 EMA as well. But let's hop across to Nimesh. Nimesh, it's that sort of a day. What's the flow picture looking like? Big selling is what we're seeing at the low point of the day and really nowhere to hide.
Absolutely, Nigel, nowhere to hide. And especially the pain is in the broader market stocks. Look at the small cap index, that's down 3.5%. And now I'm seeing clearly there is capitulation signs in the broader markets. A lot of stocks are hit 10% down circuits, and a lot of small and mid caps are under pressure today. From a flow perspective, again, I've been saying this for a while now that the FIs continue to be net sellers. Even today, the feedback is that the buy-sell ratio is close to 1:2 on the sell side. But I spoke to a lot of large HNI investors, some mutual fund managers as well. A couple of reasons why we are seeing such a sharp fall. And if you look at it, India is actually underperforming the global markets as well. And this is specifically India reason. One, there is lack of buying interest now. There is a bit of momentum which is broken in the broader markets. Two, and the bigger reason is the earnings. I had flagged off the Q2 preview, and it was expected to be the worst in the last 3 years in terms of top line growth of just 2% or 3%. Now you're seeing actual numbers, and that's why you're seeing sharp reactions. Look at, we're just flashing SRF numbers, a big margin miss, a big top line miss as well, and that's been the trend across a lot of companies and sectors. So I think earnings, disappointment has been the biggest reason for such a sharp fall in the broader markets and in the large cap names as well. From a flow perspective, as I said, there is selling pressure, but financials and healthcare stands out in terms of sell flows from larger institutions today. And again, the feedback seems to be very clear that even from a domestic flow perspective, the flow is now clearly shifting from value to quality. When I mean value to quality, I guess all the value stocks, which is the PSU basket, all the momentum names, which is the broader market stocks, money is clearly shifting from there to quality where there is to hide in terms of earnings. Look at what happened to HDFC Bank, strong earnings, and that's not fallen much. Today, City Union is a classic example, a small hit, and you've seen a big reaction to that as well. So clearly, Nigel, the feedback seems to be market is panicking more to earnings, which has been a disappointment, and of course the flows are not supporting as well in the broader markets.
Oh yeah, absolutely. It is looking quite dire at this point in time. Nimesh, what about individual stocks? I mean, the whole market is a talking point today, but any individual names, any chatter?
Well, I've struggled to find out few names, but nevertheless, a couple of names to talk about. The first name is Green Panel Industries. We had flagged off an initiating report a couple of days from a domestic brokerage firm. The stock has been in that range for a while now, but now understand there could be a large block deal in Green Panel very soon. So that's the first name. The second name is BHEL. Within the PSU basket, this is one stock which has been underperforming for the last couple of days. Even today, after a 8% fall, you're seeing selling pressure from larger FIs. So it looks like some larger institutions are aggressive sellers in BHEL even at this price. And the last is ITD Cementation. Again, the stock from the top it has corrected almost 10%, but the stock also had rallied in anticipation of a deal which looks like is round the corner now. So been under pressure of late, but the street is anticipating the corporate development very soon in ITD Cementation.
Okay, all right. ITD, the deal perhaps round the corner, as Nimesh points out, imminent. Nimesh, thank you very much for that. I mean, it's a down and out and how kind of a market, and we lots of individual names, etc. Of course, also on the correction mode. We'll take a quick commercial break. Okay, I think Mitesh is with us with a quick buy today or sell today, buy tomorrow kind of trade. Mitesh, what do you have? Mitesh, you'll have to unmute yourself.
Now I'm audible?
Yeah,
this good?
Please.
Yeah. Sorry. So SRF is something which I would recommend STBT with a stop at 2200 and a target of around 2140, 2130 on the downside. Practically, I think the entire market looks weak, but I would be slightly cautious on sell side. I will not be very aggressive in the quality terms purely because of the fact that we are now hitting oversold levels. So a gap up can always happen, but yet the trend is on the downside, so we'll go with sell calls. So SLF is one, and the other one is Voltas. Keep a stop at about 1807 and look for a target of 1775.
Okay. All right. Thanks a lot for that, Mitesh. Well, let's hop across to Sonal. She's here to give us a brief insight into those numbers that were flashing here on the screen. SRF's number. Sonal?
Well, SRF, it's a weak set, much lower than what the street was working with. And it's not only a YOY decline, even a quarter-on-quarter decline is what the street doesn't seem to like. And we've seen that on weak earnings, reactions have been quite sharp as well. If we talk about the numbers, the net profit has declined by 33%. The revenues are up 7.8% on a YOY basis, but they've declined sequentially. Even the EBITDA has declined sequentially. And if we talk about the margin number, it has come in at 15.7%, which compares with a poll of 18.5%. That too has come off on a quarter-on-quarter basis. Now, we were expecting the chemical segment not to do well this time, and that has exactly what has happened. The chemical segment has seen an EBIT decline of 30% this quarter. That's a YOY decline. While the packaging segment, as expected, has done well. There's an improvement of around 6.5% as supply has improved. But the technical textile segment is absolutely in line with estimates of a decline of around 4%. Now, going forward for a company like SRF, which had given a guidance of around 20% growth in their chemical segment, that is something that needs to be looked at properly, because there is an expectation that they could go ahead and cut that guidance. So management commentary for the second half will be very important to watch out for SRF. But on the whole, the numbers look disappointing, much lower than what the street was working with.
Okay, all right. Thank you very much for that, Sonal. Appreciate it. Well, we'll step into a break, but here's a programming note. The biggest market experts will be joining us on CNBC-TV18. And this year, we are giving you a chance to meet your favorite market experts. 5 super fans will get a chance to visit our studios here on Thursday to interact with the biggest market experts. Write to us on our social media handles, tagging @25 years of CNBC TV18 to take your chance to meet CNBC TV18 Market Movers Forum at 3 p.m. day after tomorrow, that is this Thursday. Okay, welcome back. 6 minutes to go for market close. Jay Bala is with us of cashthechaos.com. Jay, good to have you with us here. I think today you can say, I told you so, because you got that fall. And so what next from here, Jay? Your thoughts, Nifty, Bank Nifty first, and then we'll talk about mid caps and small caps.
Yeah, that's right. Good to be here, Prashant. See, we discussed on the 1st of October that there's a possibility of a reversal has arisen for the market because time cycle had completed on the September 27th, and later on it took out the support at a key support that I had pointed out. And on the day itself, I had pointed out that if it takes out that key support, we are looking at the market going back to the post-election low of about 21,800, and that looks more and more the most logical price objective for the markets. And if you look at the small cap, large, mid cap, and the micro cap, they've all broken down, and many of them are clocking head and shoulders top, and the price objectives remain much lower from current levels. And I had anticipated the short-term bounce to come through for the Nifty, but whereas for the Nifty, the bounce has been lacking, and in fact, it surprised me to the downside, whereas it came through for the banking index. So that tells me the market is actually weaker. The nearest support for the Nifty is actually at 23,890 to 23,800. And for the banking index at about 49,500. I'm still anticipating some bounce to come through, but the fact that the Nifty broke the October 7th low without giving a chance, that's a bit of a surprise and pointing to weakness.
Okay, by the way, if it's any comfort, I'm looking at global screens and they're all flashing red as well. So we're not isolated in this global fall, you could say that. The CAC is down about 0.6%, ditto for the FTSE. Some of the peripheral European markets like Italy, etc., are down about 0.7%. And let's look at the pre-open rates. So yeah, right now the pre-open rates in the US suggest that it'll be a bit of a cautious start, but 0.5% lower. Lot of major earnings in focus later tonight on Wall Street as well, including the likes of IBM, Tesla, and a couple of others are coming out today. Okay, Jay, so what should be done? What is the approach? Would you venture in with any longs at all right now? Would you stay away? I mean, so what's the strategy in terms of either an index trade or stocks?
Yeah, the best to do is to wait for a bounce to come through and then look for resistance to be hit and then take a short position. But even at current levels, a couple of stocks look weak and they may drop even if the market were to bounce. I have two picks for today. One is BPCL. It's a short with a stop loss at about 355 and an objective of 270. And Bosch is another one. I have a short with a stop loss at about 39,088 with a price objective about 31,000, maybe even 29,800. The Bosch has completed a move from the 2022 low and is clocking a reversal on its weekly time frame. So, this might be one of the stocks that going to probably fall sharper, but be measured in your shorting positions.
All right. Jay, hi, good afternoon. Congrats first on getting the call right. You have been sounding cautious the last few weeks and credit where it's due. So good going on you. I want to understand support levels. Nifty, Nifty Bank, as well as Nifty IT Index. On the Nifty, I think you briefly mentioned 23,900. Could you confirm that and also tell us about supports on the other two, the pillars of the Nifty?
Yeah, that's right. See, the support for the Nifty is 23,890 to 23,800. And a bounce should come through from there, and then a greater decline should ensue after that. For the banking index, the support is at about 49,500. And post that, we are looking at a decline, once again, close to the June 4th low after a small bounce. The Nifty IT index, the support comes at about 41,000. If that's taken out, the next support is at 37,700. So 41,000 is absolutely key. If it takes out that, it's an indication that a medium-term trend reversal might come through, but that confirmation will come through only at about 37,700. But we'd be cautious out here.
Jay, I think last time we spoke, you were cautious in US markets as well, right? I mean, that's the other shoe which is not dropped, and I hope it doesn't drop.
Right.
What's your sense? Yeah,
that's right, Prashant. I pointed to a time resistance coming through for the US markets on the 21st of October. We had if you look at the Dow futures, it's come through. It's had a bearish engulfing reversal yesterday. And if we have a follow through today, because one day doesn't make it a trend, if we have a follow through today, there's a great probability that the US markets will also start correcting, and that correction could take the US S&P down somewhere close to about 4,900 to 4,800. And the more important thing is the Nifty topped on the 27th of September, and that's the exact day the US dollar index also bottomed. And the US dollar index has rallied for the last 15 of the last 16 sessions. And that's after clocking a fresh 52-week high. That's a very, very rare event. And each of those 15 sessions, the US dollar index closed much up above the open or very close, just above the open. So that's sending you a very strong signal for the dollar index. And once again, the low for the US 10-year yields, that's also registered important low on the 17th of September. And we might actually have a trend change here, but need a little more confirmation.
All right, Jay, thank you very much for joining in with that perspective today. Let's quickly wrap out what has been a really, really bad day for the bulls. A crunching 300-point fall, which has seen the Nifty break a lot of